All right, we have more changes unfolding in the U.S. financial system and in the bowels of the U.S. government. Changes that have big money investors and investment banks as well beginning to raise the alarm after more Treasury bond issuance is coming in the next few weeks. We are talking big money here, folks, over issuance, likely in response to the changes that we're seeing over on Capitol Hill. The Treasury wanting to get ahead of any clampdown in government spending that the new congressional leadership tries to put in place, as we have this new uber conservative Speaker of the House, a big fiscal hawk. Well, hopefully he can rein in some of the spending, but it's unlikely. And this is now a concern, folks, a concern being raised by a number of investment banks and by a number of the analysts that I personally follow, who normally are all for government spending, but not this time. This time there is something more systemic taking place, making everyone a bit nervous about this. But before we get started, press the like button and consider subscribing. It helps me out, and I appreciate your support. So the Fed, folks, the U.S. Federal Reserve and all its voting members are meeting this week for the next FOMC meeting. This meeting happens 8 times per year when the group of Fed governors and presidents get together and they decide what to do about our economic policy, whether to raise the overnight rate, leave it unchanged, or cut, etc. A meeting that usually sucks all the oxygen from the room, waiting to hear and read what they decided to do. But not this time. This week, there is another event that's grabbing everyone's attention, and it's not Jerome Powell's press conference, folks. Instead, it's what's happening across the street at the U.S. Treasury, run by Janet Yellen, the department that handles all of the U.S. government's borrowing needs, the borrowing needs that seem to go nowhere but up. Now, this is what our national debt looks like right now. The U.S. national debt now sitting over $33 trillion, $33.68 trillion to be exact. This number crossed that $33 trillion threshold in September, only a bit more than a month ago. That means that we're borrowing around $20 billion per day for the last month. And since 2020, listen to this, since 2020, just 3 years ago, our national debt has jumped $10.3 trillion. Trillion with a T, folks. All of this to just keep the lights on, to pay the interest on this boatload of debt, and to keep funneling our taxpayer dollars to fund military conflicts around the world. All of that kind of stuff. All right, so with that in mind, what's everyone focused on this week, and why is it a bigger deal than what the FOMC meeting has to say and take place? Well, each quarter, the Treasury publishes what's known as a quarterly refunding statement that details its plans for just how much money they're looking to borrow. Their plans for this quarter's note and bond sales, basically. Now, usually this isn't like much of a watched event, but unsurprisingly, after the recent downgrade of U.S. government debt by Fitch and the constant and never-ending run-up in borrowing, this report is now top of mind. Realize bond markets, folks, have been going haywire, specifically the Treasury market. U.S. Treasury, still thought of as like the most secure and safe haven asset available, have been getting crushed. A sell-off, a massive sell-off has been taking place. We've been talking about it in prior videos, which is why we've been seeing the yields jump through the roof as of late. But why? Why is that happening? All of the turmoil around the world, geopolitically speaking, should have people flocking to U.S. Treasuries. And it technically has been. If you look at flows, last week saw the largest inflow to intermediate Treasury funds since August of 2022, and the largest inflow on record to long-term Treasury funds, a massive spike. Again, largest ever recorded. But even in the midst of that, prices barely rose and yields barely fell, raising anxieties for what the Treasury's about to report. If they were to come out, for example, on November 1st and report their plans to increase notes and bonds again, like they did last quarter, for instance. Last quarter, by the way, they informed us that their plans were to borrow over $1 trillion, sell $1+ trillion in treasuries, the largest number with the exception of the pandemic. Well, if they were to do that again right now, with all of this happening, investors are worried that we're going to see this bond sell-off continue and possibly ramp up. as the more supply that they flood into the market, the more demand they will need to find. The higher the risk premium needs to go, which is good for us investors looking for yield, but bad for our country, bad for the economy. Now, they'll always be able to find enough demand as long as the yield's high enough, obviously. So this is the dilemma right now. This is what everyone's watching. I showed the term premium, for instance, in last video, how it's been spiking. Think of this as like the additional yield that gets added on to incentivize investors to buy these treasuries. Here's what Bloomberg says about this. The name of the article is Why Treasury's Borrowing Plan Has Market's Attention. Written on October 25th, they ask this question. Have any signs emerged that demand is lagging supply in the Treasury market? This is what they write. Although Treasuries are still considered the world's risk-free haven of choice, the Treasury Department has recently had to pay a premium to buyers of its debt. That is, more auctions have been completed with so-called tails, which means that debt was sold at a yield that was above the yield that was anticipated ahead of the sale. That's a sign of tepid demand for the security. So while there's no risk of a Treasury auction failing outright, meaning that the government can't find sufficient demand in an auction for the amount that it wants to sell, the deluge of supply could cause the Treasury to increasingly have to offer better prices to investors to sell the securities. In this way, the November 1st statement will provide clues about how much of a premium the government will have to continue paying. Now, something that they don't say there, and why a lot of traders and investment banks are now concerned about this and raising this in their reports, and actually getting more and more concerned just recently, the reason is because all of this is now left to the market, folks. The Fed's no longer backstopping the Treasury market nor the mortgage market, so they need regular investors, real investors looking to lend their money out. For the last 15 years, up until March of 2022, the Fed was the largest buyer of U.S. Treasuries and of mortgage-backed securities, a massive whale of a buyer, scooping up trillions in assets from the open market, building a behemoth of a balance sheet as well, which you can see right here. This is the Fed's balance sheet, folks, as of last week. Just under $8 trillion in assets in mortgage-backed securities and treasuries, and since early 2022 have been shedding $60 billion per month like clockwork. This is QT in action, folks, quantitative tightening, unloading all of the treasuries and mortgages that they bought up during the last decade, especially during the pandemic, during their quantitative easing periods. And all of this is affecting asset prices. The quickest to be affected are stocks. The stock market has been taking a beating, and now index after index down across the board. Take the Russell 2000, made up of small cap companies, right now down over 33% since its November 2021 peak. 33%, folks. How about the S&P 500, closing Friday at 4117, now down almost 15% since its January 2022 peak. And the run-up that we all saw during the banking crisis, the rally that made all of us feel like great investors, was artificial. Just like the majority of the gains that we've seen, juiced up by the Fed's quantitative easing, pumping more money into the system. At the end of March, when SVB collapsed, for instance, what did the Fed do? They injected $400 billion more into the system. That's the rally that we see here. But it's fake, folks. It's not real. It's been 15 years of this now. Ever since Ben Bernanke decided to try the concept of QE, quantitative easing, and roll it out to the markets, no holds barred, the worst thing to happen to our economy, in my opinion, because as it turns out, markets no longer move based on company fundamentals. Instead, it's all about liquidity. The more QE, the higher stocks go, the higher asset prices go in general. Well, now we're in the era of QT, the opposite. And QT does what? It deflates asset prices, makes stocks fall, makes asset prices in general fall over time. Even the NASDAQ, look what happened after the Fed shot up the market with that $400 billion back in March, a rally, right? A sucker rally, though. And the reason that I say sucker rally is because it's not real, folks. The Fed was running QT at the exact same time. That money was always going to get sucked back out and bring this rally to its knees, like we're seeing now, like we're seeing here on this chart. Now, the market at this point is likely oversold, but in the big picture, the next few quarters have nothing but headwinds coming for the U.S. economy, folks. Keep that in mind. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.